Okay, so HIMS and HERS just announced a monster $1.15 billion acquisition, but their free cash flow just suddenly plummeted to negative, which is, that is wild for a company supposed to be this asset-light darling. You're listening to Earnings Unscripted, where we unpack what actually happened in today's earnings. Today is February 23rd, 2026, and we are digging into the Q4 results for HIMS.
Right. If you just skim the headline numbers, it actually looks okay. Revenue came in at $617.8 million, which is up a bit, like 3% from Q3. EPS hit 8 cents a share, up from 6 cents last quarter. So the growth engine is, it's still running.
Quick thing, just to sanity check and keep the lawyers happy. This podcast is not financial advice. It is just our personal opinions. Okay, so Miro, if the top line grew, why did the stock get absolutely crushed again today?
Margins and tape. Gross margins compressed down 200 basis points to 72%. But look, the really telling part is how the stock actually traded today. It already had a brutal quarter, bleeding out 41% to finish Q4 down around $33. But in after hours today, the exact minute management started talking on the 5 p.m. earnings call, shares fell off a cliff.
Wow.
Yeah. It dropped another 8%, down near $14 at the lows.
That is literally the sound of investors fleeing the room the second the CEO opens his mouth, which is kind of funny because on paper, their core telehealth business for men's health, weight loss, all that, it sounds like a dream. They even had this stat on the call where 70% of people doing an at-home lab test with them find a treatable risk. That is just a massive built-in sales funnel.
It is. It's an elegant funnel. But funnels require capital. They swung from a positive $79.4 million in free cash flow last quarter straight down to a negative $2.6 million this quarter. So you have cash going negative, margins shrinking, and at the exact same time, they are promising over $1 billion for Eucalyptus down in Australia.
Hold on. They dropped from nearly 80 million positive cash flow to negative? That is a brutal swing. All right, let's get into the details on where all this physical cash is actually bleeding out to.
It is bleeding into concrete, literally. They spent $59.4 million in capital expenditures just this quarter. For the full year, they breached $225 million. They are building a million square feet of fulfillment space.
Wait, 1 million square feet for a digital platform?
Right, exactly. The entire thesis of HIMS, historically, they were this beautiful asset-light darling. You fire up an app, a doctor clicks a button, and a third party ships you the medicine. But that model is... well, it is breaking under the weight loss boom. They are suddenly a heavy manufacturing company.
Okay, but why the sudden pivot? Why not just keep outsourcing the heavy lifting? Because
the FDA changed the rules, or rather, they went back to the old rules. Look, during the semaglutide shortage, HIMS could use 503B pharmacies. That is bulk outsourcing, big batches, highly efficient margins. But now that the shortage is resolved, they have to rely purely on 503A exemptions.
Right. And 503A, that means they have to compound and ship prescriptions for individual people, like one patient, one specific formulation, which is so much harder to scale.
Precisely, and it physically breaks their cash conversion cycle. Before, they could charge you for a long-term supply upfront, ship it out efficiently, and sit on the cash. Now, because of these 503A rules, they have to use shorter shipping cadences. It just completely clogs the pipeline.
Oh, wow. That actually connects perfectly to something the CFO flagged on the call. He gave this explicit warning, quoting here, an approximately $65 million revenue headwind in the first quarter purely from this change in shipping cadences, which is, that is a massive pothole for a hypergrowth story.
$65 million is not a pothole. That is a crater. And the cash flow squeeze suddenly makes total sense. Operating cash flow fell from nearly $149 million last quarter to just $61 million now. You add in those massive factory costs and you go negative. It is just gravity catching up with software margins.
Can I jump in here? Because there was this honestly kind of wild, unscripted moment during the Q&A that feeds right into this whole regulatory mess.
Oh, you mean the pill comment?
Yes, the CEO just casually admitted they, quote, pulled the weight loss pill back to prioritize engagement and relationships with ecosystem stakeholders.
Ecosystem stakeholders. That is fantastic corporate jargon.
I know, right? But think about what that actually implies in human terms. Who are those stakeholders? Big Pharma, the FDA, supply chain partners. Someone basically leaned on them hard enough that they yanked an entire product innovation off the market to appease them.
Well, they are entirely at the mercy of that ecosystem right now. You cannot wage a shadow war on the major drug makers while simultaneously asking the FDA for compounding leniency. It does not work. But this is the real paradox, Susie. They are acting extremely defensive with the drug supply lines, but hyper-aggressive with their capital.
Yeah, the M&A strategy is just wild right now.
Right. Look at Eucalyptus. They are committing up to $1.15 billion to expand into Australia and Japan, and they are claiming they can fund it with existing balance sheet strength through 2029 without massive dilution. They also bought Your BioHealth for $150 million to do at-home blood testing. They are making all these aggressive acquisitions while their internal free cash flow just went negative. It is walking a very thin tightrope.
They are definitely running hot. And with the CFO saying they're going to focus on growth over margin expansion internationally, it feels like they are, racing to build a global moat before the compounding loophole fully closes on them. So stepping back from the factory floors and the M&A spreadsheets, where does this leave their actual trajectory heading into next quarter?
It leaves them betting the house on execution. Look, they still owe roughly $1 billion on those 2030 convertible notes. Management swears they can digest Eucalyptus over 4 years without huge shareholder dilution. But when your cash flow dips negative, that margin for error gets very, very thin.
Right, and you can almost see them trying to rewrite the story for Wall Street before that happens. They're completely sunsetting that old online versus wholesale reporting structure. Starting next quarter, it is entirely U.S. versus rest of world.
Which makes sense globally. Wholesale is clearly losing its strategic importance. But they also quietly killed their online ARPU metric. They are basically merging the wholesale economics and direct consumer revenue into just one broad monthly revenue per user number.
Wait. Are they just kind of hiding weaker domestic margins behind that massive new international volume?
Probably. They told us directly that international is going to be growth first, margin later approach. Blending those KPIs naturally smooths out the rough edges. But to be fair, if Eucalyptus actually brings in the $200 million they expect in the back half of 2026, the market will likely forgive the metric shuffling. Credit where credit is due. It is a very ambitious global swing.
It really is. It feels almost like they are stitching the parachute while falling, just rapidly transitioning from a quirky telehealth app into this complex multinational platform in real time. But that $65 million revenue gap for Q1 is still just looming there.
Exactly. The narrative up to this point was always infinite digital scale with zero gravity. But now they are pouring actual concrete, battling the FDA and running global supply chains. It is heavy corporate physics now.
Heavy corporate physics. I love that. We will see if their balance sheet can actually handle the gravity next quarter.
It really will be.
All right, that is probably enough damage for one episode. If you want these quick earnings drops to just show up for you, go ahead and follow the show. Just a quick reminder that we do use AI tools to pull the transcripts and filings so we can just summarize what actually matters. We always want your ticker requests, so drop us a note at earningsunscripted@datamadness.ca or just find the X link in the show notes. Thanks for hanging out, and we will catch you next time.
Take care, everyone.